ETFs are exchange-traded funds, meaning they are funds that are traded on the exchange or on a listed market, right? So what that means is, if, for example, you get to market and you want to purchase or sell a product, you can do it either through an organized exchange or through OTC or over-the-counter market. So, as the name suggests, ETFs are traded on an exchange, meaning all the contracts or trade executions are standardized, right? And there is a regulatory regime that manages how they are traded. Now, I can give a small example so then we're able to understand what ETFs are. Now, take, for example, you have gone to a market for fruits, and there are oranges, tomatoes, apples, mangoes, and such like. Then you realize the price of, say, one mango is 20 shillings, and one apple is 50 shillings, and a banana is, say, 10 shillings. Then you find somebody who's fairly smart and they decide, no, I cannot be selling these fruits as one each. I can actually mix them up. So then I have one mango, one apple, and maybe one tomato sold as a package in one basket. Now the pricing of that would be slightly different from if somebody sold these fruits separately. All right? So the very fact that you are doing an ETF, it means that you are bringing together a basket of instruments, or in this case of oranges and tomatoes and bananas, for example, together, to sell them as a unit as compared to, or as opposed to, selling each of these fruits separately. And why would one want to do that? Sometimes you want to take advantage of market needs. So you might find that there's a customer who does not want to buy or to purchase oranges separately. They want a mix of fruits, so then ultimately they get the benefits of each of those fruits instead of, say, buying one set at a certain price. Ultimately, one aims at getting the full benefits of price fluctuations in the market. And this is how it happens. So if, for example, one bought an ETF, in which case then you would have a mix of shares if it's an equity ETF. You would, for example, bring in Bamburi and, just as an example, Equity Bank and maybe ABSA together, and then create an index out of those shares, and that index is the one that you price. So once you price, it means you are creating a unit that is equivalent to purchasing those three shares combined. So of course you have the alternative of going to market and purchasing each of those shares separately. So it's ultimately trying to take advantage of the market opportunities that there are, and ultimately benefiting both as an issuer or as an investor at the end of it all. The first thing one does is that there has to be a sponsor or an issuer. So this is the person who has innovatively come up with the idea of creating an ETF. All right? Then there has to be a relationship with a market participant who is an expert in terms of interacting with the market. So we have had two parties here, the sponsor or the issuer on one end, and the market participant, who is like the sponsoring entity who would then interact with the market in terms of selling these units. Then thirdly, of course, we have the investor, who is the end user of this ETF product. So what then happens is this. The first thing that happens is that the sponsor has to come up with that idea and say, I'm going to create an ETF unit out of 3 shares. And the minimum amount of shares that go into an ETF is 50,000 shares. So you would have 50,000 of each of the companies that you want to put in an ETF arrangement. So assume that this party has then bought 150,000 shares of different companies that will be put into an ETF arrangement. So this issuer then commands or proposes to the market participant to purchase these shares from the market. Of course, payment is made at the very initial stage. Once those shares have been bought, they are transferred to the sponsor, yeah? so that they are able to be analyzed and evaluated so that the sponsor is satisfied that these shares are the ones they were interested in creating an ETF. So in return, the sponsor transfers what we call creation units or ETF units equivalent to the proportion that was initially agreed between the sponsor and the market participant. So for example, out of the 150,000 shares that we talked about, we could have a creation of, say, 30,000 ETF units. These units are then transferred to the sponsor, not the sponsor, but the market participant, so that ultimately the market participant sells these ETF units to the investor, right? And so ultimately, once that transfer has happened, that is like the first leg of everything. Thereafter, when, for example, the investor is keen on selling the units, then there has to be a primary and secondary market for this to happen. And it is just like the ordinary market that we have. So there's a primary market where the participants are usually institutional investors and those who are sophisticated, who know exactly what is happening. They are the ones who purchase these units. So assume for our example sake, we have had 30,000 units already created, all right? Now, these units will then go through a primary market issuance process. So for our sake, let's assume that each ETF unit now becomes 15 shillings. And therefore, each investor who wants a unit of the ETF would have to pay 15 units. For example, in our market, you need a minimum of 100 units for you to be able to purchase these units. So therefore, if you do 15 times 10, 100 units times 15, you can see how much would require for you to be able to invest in this imaginary ETF unit we are talking about. Now, this is in the primary market. So in the secondary market, once the ETF is listed, then you have a trading between investors. And in this case, the initial investors who participated in the initial offer of the ETF then sell, or can I say on sell to other investors, these ETF units. Now, if somebody is keen on selling and purchasing these units, these units are then freely available within the market for that purchase and sale to happen. Going back to the advantage, or can I say advantages of ETFs, you can immediately see there is some level of diversification that has taken place, because initially, if the investor wanted, they would have been buying shares separately. So if, for example, you're purchasing Equity Bank or ABSA or Bamburi or whichever other, you would have to purchase separately for you to be able to access each of those companies. But in an ETF arrangement, if those ETFs were created out of those companies, then you can easily see that the exposure that the investor has is diversified such that if, for example, just for example, if Equity Bank is not doing well, then there is Bamburi or ABSA that could be doing well. So the average price of the ETF could be, sorted out or balanced off, such that if there is a gain on one end and a loss on the other end, the investor gains somewhat rather than purchasing or holding just one type of or one company out of those that are listed. The other advantage is that it helps in deepening markets. And in an ETF arrangement, there has to be a market maker. A market maker is a market player who stands ready to either purchase or sell a security at market price at any time when the market is open. And therefore, there's an advantage of deepening and creating more liquidity, because you would have more participants coming in and going out, because there's a market maker who is participating in this arrangement. The third advantage is the fact that you can reinvest your dividends out of these securities that you have put in a basket. It's advantageous, therefore, that in a case where that has not happened, you have to wait for a company to do everything around book closure and everything, so that ultimately you can get the dividends. But if you have put your money in an ETF, once a company declares a dividend, then that is usually input into the pricing and the gains of the investor, just because there's a view that has been had by the participants that you've actually gotten a dividend, and they're able to see if it's making part of the constituents companies that are in the index that is making the ETF. Once they have a view of that, that can be transitioned so that the dividends that have been earned can be transferred to your account as the investor. The disadvantages are also a number. Sometimes you can find there's a difference in pricing between the individual shares, or in our case, the example that I gave, you could find there's a difference between purchasing the individual fruits and the basket of fruits that are a mix of all those that we talked about. So what that it means is that that discrepancy in price can sometimes be very wide. And when it is wide, somebody has to lose, and that is one of the disadvantages. The second disadvantage, or can I call it a challenge, is that in terms of earning dividends, there are costs involved, because there are professional services that have been offered here by both the sponsor and the market participant. And they have to charge you for offering that service. So ultimately, if you had bought an individual share, it then means that there are no admin costs that could be involved if you directly bought these shares from the market. But because this is being put through some professional arrangement, ultimately there is you don't get the full dividend of what you would have gotten if you had bought the shares as an individual share and gotten the dividend at the end. We already have a framework in place that supports the listing, trading, settlement of ETFs in the country. Also, from a market development perspective, ours is to convene stakeholder engagements to find out, first of all, are there any challenges that are being faced? Are there opportunities that are not being taken advantage of? What is the outlook like? Who could be the key players, and how possibly could we have more uptake in the ETF market? So, in fact, recently we hosted a stakeholders meeting, and it was very successful, very well attended. We had a very deep conversation around how we want to drive ETFs in this market. Our interest is to ensure that we don't have only one ETF. In fact, in some markets, there are quite a number, like South Africa. It has several. So the challenge that we are throwing to the industry out there is there's an opportunity here for you to structure an instrument that could ultimately accrue some benefits to you as a market player, even as you deepen our markets through ensuring that there's a lot more uptake. Then we are also usually in constant communication with some of the market players. We recently had conversations around the same. We continue to evaluate whether we should be having some of these engagements as, annual engagements. And you have to realize sometimes in Kenya, something has to give for somebody to start getting interested in a market. Just as an example, fortunately or unfortunately, during COVID time, the uptake of ETFs in Kenya actually skyrocketed. And also, if you look at some of the figures that we have had lately, because as you realize, given that we have a gold bullion ETF in our market that tracks the price of gold internationally, there has been a lot more interest because the US dollar investment usually goes inverse to the investment in gold. And therefore, when there was a lot of fluctuation or turbulence in foreign currency trading, people shifted to accumulating gold, and therefore that's why we have seen a lot more uptake of ETF units in our market.